So I was recently in a discussion with a friend and we were talking about returns on property and how they compare to stocks. And this is a really touchy subject because many people have to rent. They can't buy a house because buying a house has become so expensive. And I'm not a conspiracy theorist, but I think a lot of people out there want people to believe that renting is better than buying a house. So I told my friend, when I watch videos and they compare renting versus owning, they conveniently often leave out things which make buying a house look much better than renting. For instance, in many videos they say that rent is often lower than paying down a house mortgage. However, they conveniently leave out that the interest paid on your mortgage can often be written off against your taxes. Of course, this depends on your country. So in this video, I will go through why property can beat stocks. You've probably heard really strong opinions on both sides. Some people say just buy index funds. If you do this, you will beat property over time. Others say real estate is how people get really rich. But here's the truth. Property can outperform stocks. Not always, not without risk, but structurally it can. And in this video, I'll explain why property can beat stocks, the 4 real advantages property has over stocks, and when stocks are actually the smarter choice. Let's start with the biggest reason, leverage. This is the core reason property can outperform stocks. Leverage. With stocks, if you invest 50,000, you control 50,000. If the market goes up 8%, you make 8% on $50,000. Simple. But property works differently. Let's say you buy a $300,000 property. You put down $50,000, the bank lends you the rest. Now you control a $300,000 asset with only $50,000 of your own money. If that property increases by 5%, that's a $15,000 increase on the $300,000. But you only invested $50,000. That's a 30% return on your cash. That's the power of leverage. You're earning returns on the bank's money too. This is why real estate investors can build wealth faster. But there's a flip side. If property prices fall 5%, you lose $15,000. Leverage amplifies gains and losses. That's the trade-off. The leverage also gives you risk. You're at the mercy of the central banks. If inflation runs rampant, they have to increase the rates to reduce inflation to the 2% goal. The second reason property can beat stocks and ETFs is forced appreciation. With stocks and ETFs, you're passive. You buy shares, you wait. You cannot influence Apple's performance or the S&P 500 performance if you're not a CEO, CFO of one of these companies. And then you're probably not watching this video. But with property, you can create value. You can renovate, improve the layout, add another bedroom, increase rent, improve management, lower costs. You have control. That's the point. You're not just hoping the market goes up. You can force the value higher. That's something stocks don't allow at the individual level. And for people who like being active, that's powerful. And for people who have a good eye for location, property, and renovations, property might be the better pick. They can do more to force appreciation. For instance, if you buy a house for $300,000, you renovate it for $50,000, now it might be worth $400,000. So you just created $50,000. And this has a double effect because your equity in the house just increased. So you might be able to go to the bank and argue that you should be able to have a lower rate because your equity now is so high in the house, and their risk has therefore decreased. The third reason property might beat stocks is cash flow. Property also produces something very tangible, monthly income, if it's a rental property of course. If you own a rental property and the rent exceeds your mortgage and expenses, you generate positive cash flow. That money hits your account every month. Stocks can pay dividends, but these are often yearly, quarterly, or every half year. But rental income often feels more predictable and controllable. You have direct control over it if it's your rental property. And rents tend to rise with inflation. Over time your mortgage stays relatively fixed, but rent increases. That spread can grow. That's another structural advantage. Also, if you rent, your rent will increase with inflation. But if you own, your mortgage will stay the same. This is another huge advantage of owning property instead of renting. Many people often leave this out of the equation. If you own a house for 40 years versus rent for 40 years, the mortgage stays the same. It's $1,000 every month. But if you start renting $1,000 every month at 2% inflation over 40 years, that rent is going to increase a lot. But the mortgage, not so much. It will stay the same. If, of course, interest rates and so on stay the same. This is something I didn't quite think about before considering renting versus owning. However, when I first moved to the city I currently live in, I was renting. I was paying about $600 every month. And now, after 8 years, that rent is at approximately $1,000 every month. However, 5 years ago, me and my girlfriend bought our apartment and we have been paying exactly the same every month for 5 years, despite inflation. The next reason property might beat stocks is tax advantages. Now, this of course depends on where you live, but in many countries property has very favorable tax treatment. Examples include depreciation, mortgage interest deductions, long-term capital gains benefits. For instance, in many countries, when you sell a house you're living in, you don't have to pay capital gains tax on what you have earned, meaning that if your property increased from $300,000 to $500,000, you earned $200,000 and you don't have to tax on it at all. However, with stocks in most countries, you have to pay capital gains tax on what you earn. So if you go from $300,000 to $500,000, you earned $200,000, you have to tax maybe 30-40% of that. Also, in many countries, you can write off mortgage interest, meaning that even if owning is a little bit more expensive than renting, in many countries it actually still makes sense to own. Of course, before you don't take my word for it, speak with a professional if you're actually considering buying. However, you can sometimes reduce taxable income through property expenses. Stocks usually don't offer the same level of tax structuring. Again, this depends on location, but it's often a meaningful advantage. But now I'm going to discuss where stocks actually win. Now let's balance this a little bit off, because property is not automatically better and have better returns. Stocks have some serious advantages too. First, simplicity. You can buy an index fund in 5 minutes. No tenants, no repairs, no renovations, no phone calls, no legal paperwork. Second, diversification. One index fund can give you ownership in hundreds of companies. With property, you're often concentrated in one asset in one area. Third, liquidity. You can sell stocks, mutual funds, ETFs almost instantly. Selling property can take months, and in some instances, such as in 2008, it will be almost impossible to sell at a reasonable price. Fourth, stress. Debt amplifies returns, but also anxiety. If you lose a tenant or the market drops, the mortgage still needs to be paid. Stocks don't send maintenance bills. Also, if you lose a tenant and you have a rental property, it might be a huge crisis. Suddenly you have to pay 2 mortgages on 1 paycheck. You don't have a tenant who will rent. And in some cases it might take months to find a new tenant. And if you get a really bad tenant who doesn't pay at all, it's a huge crisis as well. And in many countries, renters have really strong rights, so it's difficult to remove them. So when does property actually beat stocks? Property can outperform stocks when you use leverage responsibly, you learn from 2008, you buy in strong locations, you manage risk properly, you hold long term, you actively improve the asset to increase your equity in the home. It rewards involvement. Stocks tend to win when you want passive investing. You prefer simplicity. You don't want the operational stress, someone calling you, a tenant calling you at 5, telling you that nothing works, the electricity is out, the water is out. Stocks might also win when you invest consistently over decades. Both can build wealth. The better option often depends on your personality. Do you like being involved? Do you like working physically? Do you like property? Do you want to be with it? It depends on your risk tolerance, your time commitment, your access to capital. Do you have capital to buy property? Do you have so much capital that it's a small risk for you to have a loan, or will it lever you over your head? However, in the end, it all depends on your situation. This isn't about choosing a side, it isn't about stocks versus property. It's about understanding the mechanics and what will work best for you. Property can beat stocks because it uses leverage. It allows forced value creation, meaning that you can improve and increase your equity in the property by improving it. It generates tangible cash flow if it's a rental property. It often provides tax advantages. Stocks can win because they're simple, diversified, liquid, and truly passive. Some of the wealthiest people combine both, and that might be the real answer, not either or, but when and how and if it fits you. If this helped clarify the difference for you, let me know. Comment down below. Do you have a property? Do you want to buy a property? Or are you all in on stocks?